Okay, everyone, so we're going to keep going here with Chapter 4, Part 1, and this is where we're going to start to break down daily charts. Again, just to reiterate and maybe just to take a moment to do a couple of housekeeping items, if you are feeling lost, I really encourage you to go back and watch one of the chapters, where there was a topic that was a little over your head. In chapter 1, I did an intro to the momentum strategy here for the small cap course. Chapter 2, I broke down risk management. Chapter 3, stock selection as a second form of risk management. And now daily chart patterns by trading stocks that have strong daily charts and by understanding what constitutes a strong daily chart, you can effectively further reduce your risk of loss. You cannot eliminate your risk of loss in trading. That unfortunately is impossible, but you can reduce it. And so as you reduce your risk for loss, you will be doing a combination of things. You'll be avoiding taking trades that do not give you 2-to-1 profit-loss ratio. You'll be avoiding trades on poor quality stocks that have high levels of high frequency trading, that have high floats, that are high priced, that are choppy, that don't have high relative volume. And you'll be focusing on stronger daily charts. And then you'll, of course, get into Chapter 5 and 6, 7, 8, 9, 10 on those intraday chart patterns that really become the basis for the entry and the exit. But right now, we can't even decide whether or not it's worth taking a day trade until we understand how a stock looks based on its daily chart. So today you're going to learn about the anatomy of a strong stock on a daily chart. We're going to talk about moving average support and resistance at half dollars and whole dollars. We're going to expand upon former runners, and I'm going to expand upon what we talked about in the starter class with daily gaps and windows. I'm going to talk a little bit about support and resistance lines in a little bit more detail than we covered in the starter, and we're going to talk about daily flag patterns. So if you're someone who skipped starter classes, you may have missed some of the important sort of foundational concepts that we were talking about in regards to daily gaps and windows and drawing those support resistance lines ascending and descending. So make sure you go back. That was in Chapter 5 of Technical Analysis of the starter class, if any of this is not already familiar. Why is this important? Well, understanding the criteria of a strong stock to trade means understanding what a strong daily chart looks like. Being able to differentiate this from a weak daily chart ultimately will keep you out of a lot of trades that will be potentially unnecessary losses. When we see stocks, and we see this happen again and again and again, today we had a stock, AVCT. Can anyone tell me what it had at the daily chart that created resistance? What was that right there? Now, we'll talk about that today, but you already know because that's the 200 moving average, and we broke it down in the starter class. This tapped the 200 to the penny. So if you didn't have the 200 moving average on your chart, or you didn't even know what the 200 moving average was, then you were certainly sort of flying blind. You were at a little bit of a disadvantage. Not having this would have potentially convinced you to maybe you would have taken a trade for the break of 7 and been surprised that it failed. Now, I might still take trades at this level, but I would know that there was a little more risk. The simple moving average, as you can see here, is a little bit higher, whereas the exponential was the one that was respected. Okay, so I'll move this back down here. So key levels. I want you to learn to anticipate the breakout levels on a chart where you would expect volume to come in. Once you learn to anticipate these levels, you can have your orders ready to buy just before the breakout. That way, when that wave of volume comes in, you can ride that wave of momentum as the stock squeezes through the breakout spot. So that allows you to ultimately get max profit and have minimum amount of time of waiting by getting in really close to the breakout just before it happens. And you don't want to be in hours before the breakout. I mean, you want to get in like just before it snaps that level, and then instant gratification, instant reward, instant breakout. So these key levels are 100% based on technicals, but they're only valid on stocks that meet our fundamental requirements for being worth trading. Fundamental being really that I suppose that they have a catalyst whether or not we would call float a fundamental characteristic or a technical, it's a number, so it feels technical, but it is part of the fundamentals of a company, the market cap, the float. It's not a chart-based thing. It is more of a fundamental, but I could see how you could interpret that either way. So in any case, these key levels are only valid on stocks with high relative volume, with catalysts, with lower floats, with low levels of high frequency trading. As far as daily charts go, some traders believe that you have to have a strong daily chart in order to trade a stock. And some traders will even pour through daily charts at night of small cap stocks, just looking for good daily setups. So, what's a good daily setup? A good daily setup might be a stock forming a pullback, something like that. My problem with doing that, and the reason I don't do that, is just because a stock has a bull flag, a lot of these stocks are trending with the overall market. So, if the market pops up, they're going to pop up. If the market drops down, they're going to drop down. And they don't actually resolve or have high relative volume until they have some type of catalyst. So rather than spend a bunch of time going through daily charts at night, I just sit down in the morning and I look at what's already moving, and then I review those daily charts. And it's going to save you a lot of time. And I did used to believe that you needed to have a strong daily chart in order to take a day trade. But then I saw so many great day trades that occurred despite terrible daily charts that I realized the right catalyst with high relative volume can overcome a bad daily chart. But the best daily chart in the world cannot overcome poor volume and low interest. Because if you have poor volume and low interest, no one's going to buy the stock. It doesn't matter how beautiful the daily chart is, no one's interested. There's no news, there's no volume, no one cares. So yes, the perfect setup is both strong intraday and strong on the daily. So 7 steps to a strong daily. The price should be ideally above the 9 and the 20 EMA, and ideally the price should also be above the 200, but it's okay if the stock is below the 200 if it has a lot of room to squeeze up to it. Now this opened above the 200, but AVCT was below the 200, but had a lot of room from $4 up to $7. We knew this was going to be resistance, but it was above the 20 moving average. It was above the 9, so that was fine there, and it had room to the 200. So that was okay. DPW, this one, let's see, where's the 200? So this was above the 200 as well. So this was fine. It's above those levels. So again, being below it is not a deal breaker, but being right below it, it's going to be kind of hitting resistance. Ideally, ideal entries will be at the $0.50 or the whole dollar. These, for me, always feel like safer entries. Usually, the reason is because we know stocks sometimes struggle underneath $0.50 or whole dollars. And so if I get in for the break, then I can really set my stop right here. If it comes back down below, it looks weak. Whereas if this same price action occurred at like $2.23, if it comes back down, if it breaks 223 and then comes back down to 217, it hasn't really broken a psychological support level in a really significant way. So I wouldn't really be as concerned. The entry at the $0.50 and whole dollar in a strong market will sometimes be a chase. So sometimes, and actually this is a perfect example today and yesterday I bought a stock right before it broke a whole dollar. It was already extended yesterday from 4 to 5. I bought for the break of 5. It broke through 5. It never retested that level. So it just was a strong break. So it allowed me to kind of chase it a little because I got in at what I expected was a psychological breakout spot. So it's better during a strong market. It's kind of a way to chase it. During a weaker market, I would not be as likely to chase at a $0.50 or a whole dollar. Ideally, the stock has a history of being a former runner. Ideally, there should be large windows of no resistance formed by gaps or windows. There should be no ascending or descending resistance that's about to block the move coming up. And daily flag breakouts or breakout of consolidation patterns are preferred because then we have that multi-time frame alignment where it's a strong intraday setup. It's also a strong daily setup. More people, even swing traders potentially, would be watching it. So the volume weighted average price is not a daily indicator. So it's not on any daily charts. Therefore, I don't talk about it from the perspective of analyzing just the daily chart. So this is essentially looking just at the daily chart. The only aspect of this that is a little intraday is your half dollar and whole dollar. And you're right that an intraday entry, which we'll talk about in chapter 5 and further along in the classes, is going to be preferably above the VWAP. But in terms of the daily chart, we don't use the VWAP. So again, don't worry about creating daily chart watch lists for yourself. I do my homework each night, but it's not scanning through daily charts looking for a setup. The homework that I do is reviewing the trades I took that day, reviewing the entries, the exits, what I did right, what I did wrong. That for me is much more. It's a much better use of my time than trying to pour through tons of daily charts, hoping to see, a really great setup, only to see it, and then the next day nothing happens because the stock doesn't have high volume. There's no news. No one cares about it. It was a waste of your time. So instead of making those daily watch lists, spending your time reviewing your trades you've taken back on the 5-minute or 1-minute chart is what I would recommend. And again, the criteria for a good daily chart should only be applied to the right type of stocks. If you start trying to analyze the daily chart of a stock like Twitter or something, this isn't something that I'm interested in day trading. So this daily chart, although you could break down levels on it and say there's gaps here and windows here, realistically, it's just, and you can see how it does have resistance here. I mean, to a certain extent, it's respecting that, but it's not something that I'm going to day trade. So I'm not going to really waste my time trying to break down that type of chart. All right, so number one, we want to see if the stock is either above the 200 or has lots of room to it. So in this example, the 200 moving average is at 393 right here. So it's underneath it, and it's kind of close to it. Now, it did squeeze up here from 3, and so if you took an entry around 3, I might have been able to say, okay, I've got $1 a share. But once it starts to get up to, 370, 380, well, at that point, you're really starting to get really close to that resistance level, which has already been respected once back here. Here's another example of this stock right down in this area. This is not a good daily chart, in my opinion. It's too close to the 200 moving average. It's right below it. So now if it opens and gaps up to 5, it's opening at the 200. And then if it squeezes right out of the gates, it might be okay. And then we would start looking to the left and up. But really, we don't have any big windows until right here, 910, up to the high of this candle, which is 1365. And then from this candle up to here. So between 5 and this level, we don't really have an obvious, on the one hand, we don't have an obvious window or an obvious gap, but there's also not a super obvious resistance point. So it could be something that maybe would be okay if it was above 5. But right now, being below the 200, I don't like it. RKDA, this stock right now is below all its moving averages. So this, in my opinion, the moving averages are crossed. It's got the 200, it's got the 9, the 200, the 20, the 50. They're all in the way. So until the stock gets over kind of this $18 spot, it really doesn't look that great. Does that make sense? GLBS right here, you can see how this popped up, pulled back, consolidation. And where did it find support? Right at the 200. Bounced off the 200 once and then twice. So in this case, the 200 became a level of support. So this would be a nicer daily chart. Not that it's perfect from the gap and window perspective, but above this level here, then it starts to have room going up. But of course, it does have that big red candle, which is not really something we love to see. Going down here, this is another one. This is on the 5-minute chart. So this is actually just a brief intraday chart that I'm showing you. But again, just to reiterate, support at the 200 moving average. These are moving averages that can be used both on the daily and the 5-minute time frame. Here's another one that actually, this is the SPY, had resistance at the 200. So it hit that resistance level right there, once and then twice. So very clear resistance at the 200. Again, not a stock that I would necessarily be trading, but a good example of resistance at the moving average. Here's a great example. This stock tapped the 200 almost to the penny, 15.49. It just tapped right there and then pulled back off that level. So although this had room from the gap perspective or windows from 12.96, which was the high of this red candle, up to the high of this green candle, which was 16.93, it had the 200 moving average cutting in the middle, so that created resistance of about 15.49. If it had broken through that level, then I would have said, yes, 16.93 is the next spot to watch. So here's resistance at the 200 moving average. Again, squeezing up, tapping that level, and then fading off of it. Let's see. Just taking a note on that. Here's another one, squeezing up. This is so close to the 200, it doesn't really look to me like something I'd be wanting to buy. But if it broke over that level of 5, then it has room up to this level here. The best time of day for a stock to break the 200 moving average is in the morning on high relative volume. So it's not to say that we couldn't potentially see a break of the 200, but it's just a very well-respected level of resistance. Here's another tap of the 200 right here. So once you have this on your chart and you start to notice this, when you see a stock gapping up here at 2, it's on the watch list, right? You've seen it on the gap scanner. The float is good. The price is good. It's got a catalyst. It's got relative volume. And then you look at the chart and you say, well, wait a second. It's got the 200 moving average right here. So can I take a trade up to the 200? Is that enough profit? Knowing we've got upside resistance? Maybe it is. Do we have anything else on the daily? No, not really. We've got room up to the high of this candle here. So we have some good room on the daily. And then above that, we've got room to here. But this is going to be our first issue. So I might still take the trade if I think I can get some profit up to that level, but if I don't, then I won't. Now, I use the 200. It's one of the most widely used moving averages. Certainly, you could put a lot of moving averages on your chart. You could put on the 50, the 100, the 75, and you may find that each of those are respected a little bit, but ultimately, the reason moving averages are respected are because so many traders use them. And so I like to use the most common, which is the 200. But if you like to use the 100, it doesn't mean that it'll hurt you. You might see, oh, well, the 100 is probably going to cross, right here kind of in the middle. So maybe you'll see, oh, it's right above the 100, so no problem. But in other cases, you might see, oh, the 100's like right here. So we might have a little 100 resistance before the 200. And there might be other people that see that as well. So it's not that it's not necessarily valuable to see those resistance levels, but it's also sort of a analysis paralysis type of thing. Right now I've got the 200 EMA and the 200 SMA. So, if I added the moving average, apply and apply, I did the 100 right here, and then the 100 here, and this one in, let's see. So this one's going to be, I'll make this one simple and change it to a dotted line, and this one's exponential. So all of a sudden, now I've got this many more moving averages. I mean, at what point is it helping you, and at what point is it hurting you? So AVCT. So you can see how this had resistance at those levels there, but it blew right through them. So I just, again, it's not to say that maybe on some stocks that wouldn't be helpful, but I don't know if they're as widely respected as your 200s. And at a certain point, you're going to have so many bands on the chart, you're going to drive yourself crazy. So I try to keep it simple and focus on the ones that are most widely used. Again, resistance at the daily chart here, tapping that level. Not quite, but close to it. Recent reverse split on this one as well. Tapping the 200 right here and then fading off that level. This one, 200 moving average is right here, and it does have a window. This is gap fill. So it gapped down and back up to 850. There's no resistance on the chart from candlesticks, but there is resistance in the form of the 200. And possibly you could draw a trend line around here as well and see a descending resistance line by connecting these candles here and then projecting that out. So that might have some descending resistance in addition to the 200. Another one, BLIN at the 200 right here, tapping to $1.81. History of red candles definitely creates more weakness. let's see. So, number 3, entries at $half and whole dollars. So it's very common on daily charts that we see that stocks squeezed up to a whole dollar and then stopped. The high a day on JIFN right now is $30 to the penny. So it hit that psychological level and then stopped. So when we go back and we look at a chart, we often, as we're drawing out our levels, we'll notice that these levels will coincide with half dollars and whole dollars on the daily chart. So if I go back here, if I drew enough of these levels in this area, I would start to expect some resistance near half and whole dollars. So right here, there's about 15. So it's technically just over 15, but you can see, 15 is clearly a spot that people would probably be watching. So, this one down here looks like it's just over a whole dollar, or maybe a half dollar. But again, as you do this on more and more charts, you start to recognize that a lot of stocks will tap half dollars, whole dollars, then pull back off those levels. So we interpret those to be psychological areas of support and resistance. They have support when it's coming down, they have resistance as it's going up. But when a stock breaks support, what happens? It flushes. When a stock breaks resistance, what happens? It pops. So I often enter a stock that's really strong as it's coming into resistance with the expectation that it'll pop through that level. I don't do that very much with the 200 moving average. I do it a lot more though with half dollars and whole dollars. Half dollars and whole dollars are much less resistance than the 200. The 200 is a very strong wall of resistance, whereas a half dollar and a whole dollar is just kind of a little momentary resistance and then a pop through that level. So if a stock is at $3.99 or so, we may see resistance at the whole dollar. How do we visualize resistance? We often will visualize it by seeing on the level 2 a large order at 4. We might see at 99 or at 4 a 10,000, 15, or 20,000 share seller. So there's a big seller on the ask. That's resistance. Now it might tap that level. If it's already extended as it squeezes up, it might pull back off that level. Then as it comes back up for the next try, through that period of pullback, we might have had a 1-minute bull flag. And then we would look for the entry and the breakout through that resistance level. So it's resistance, but it's also a breakout setup, because if it breaks resistance, we expect a pop. When we have a daily trigger that also coincides with the half or whole dollar, it makes it even stronger. So now, DPW, what was the high today? Let's see. My drawing tool screws up my chart mouse here. So 655 was our daily high, so really right near that half dollar. Okay, so coming back up a week from now, a month from now, that 655 place may be on watch. GNUS, the day it squeezed up back here, this hit a high of 1173. The low down here, this one doesn't seem to be really respecting, but back here at 2, I would say that definitely tapped that whole dollar right there at 2, broke through it. Squeezed up here to a high on this candle of 282, pulled back. Here it hit 4. So here it hit 8. So a little bit of respect there. 2, about 3, about 4, and again at 8. And intraday on this day, it may have had a little bit of resistance at those spots as well. So if we were trading this stock on this day right here, we would have been looking at the break of $8. That's a continuation setup, a break of the previous day's high, and it also coincides with a whole dollar. So it's kind of a little bit of 2 setups in one in that moment. All right, so let's see. Next one, let's see if there's anything else here. Yeah, so all right. So again, a bunch of examples here. Resistance at the whole dollar of 26. So there was 26. It broke through that level, squeezed up to 30. So that's a very impressive move. At first, it squeezed up and tapped. It was resistance and it pulled back. Came back up again, tapped and pulled back. Consolidating under that level. What flag is that? That's a bull flag. That's consolidation underneath the highs. And then this is kind of that coiling pattern. And then bop, right through that level. Nice. Here's another one. Consolidation right underneath 650. So I would be saying, okay, this stock is gapping up. It's $6.50. This is an intraday setup, But as long as the daily chart is good from the perspective of the 200 moving average, and that's all fine, then a potential entry would be over 650 here. Another $0.50 here at 750. I showed you these two examples in the starter class. Former runners. All right, so a stock that was a recent former runner, which is the case with GNUS, which we've looked at a couple times. If this stock all of a sudden comes out with really good news a few days from now, we may see a squeeze on it from 7 or 8 back up towards 10, 11, 12. We may see that type of big move. It's certainly possible. So it's definitely something to keep an eye on when you see something that was a former runner that now has news or is on the gap scanner squeezing higher. Often, because traders look at it and they're like, oh, wow, that made that really big move that time, they get this FOMO where the next time it pops up, they don't want to miss it. So the next time it starts to pop up, they're thinking, all right, I'm going to jump in it as quick as I can so I can, capture this momentum. So that's why former runners can sometimes see kind of increasing volume in second, third, and fourth days where they're hot, as traders are like, okay, it was really hot that time. I don't want to miss it, so I'm going to go ahead and jump in, sooner and even more aggressively. And sometimes these former runners can have like a cult-like following of people that are just constantly watching them, waiting for them to pop up. So LEDS, a former runner, really strong on this day, even more volume on this day. And not bad on this day or even on this day. So it likes to pop up. Cali, another stock that likes to pop up. Popped up here, 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 and here. You can see the volume bars, higher volume on those days where it's popping up. So each of those days, maybe it had a little bit of resistance or a little bit of a news catalyst, and then traders jump in it and they're like, oh, it's LEDS. This thing last time went crazy. I'm jumping in it, for the next trade. So, yeah, it's just that cult following of people just anytime LEDS pops up, they get excited. Although I will say that LEDS is a stock at this point that I feel like is kind of played out in that it's had so many days where it pops up that I don't know. It seems also that short sellers are like, oh, sweet, it's popping up. I can short it, because half the time it pops up, it ends up failing. Another former runner here, OPHC, first day, second day, third day. You can see these volume bars here on these days as it's popping up. So this was the first daily candle to make a new high, and then this was the second pullback right here. NFEC, former runner, big day here, and then again, volume comes back in when it has some good news. Traders get excited. They're like, oh, that was a stock that made a big move in the past. I don't want to miss it. Someone was just saying ABIO was popping up. Let me take a look at that one. So ABIO from 740 to 9. All right, so this is a former runner, absolutely. This is a stock that has a history of making a big move not long ago at all. The high on the daily chart, 943, just below the $0.50. So we could move this up just a little bit to 943, whatever. So that's fine. Well, let's actually just get rid of that for a second. So on the daily chart, we're going to mark out the high of this candle, 43. The high of this candle here was 46. The high of this candle, that's a gap. And then we've got room to here and then to here. So now I can get rid of these ones, remove, and all of the orange ones can get removed, but I won't remove them all right now. All right, so now let's pull this one off as well. And this one, so today's the first daily candle to make a new high. So let's switch to the 5-minute chart. So where do we have resistance levels? So right up here around 950. If we break 950, we've got room to 1025. If we break 1025, we've got room to 11. So there, dip. Is it going to dip and then pop? Oftentimes I watch these for the dip and then the pop. So ABIO. So there it is. So now we broke through that level. Next target, 1025. Is it going to come up to 10? There you go. There's 84, 90. Little resistance at the whole dollar. Now this has a clean daily chart. It's a former runner with a low float. It appears that there might be breaking news on it. So it's got pretty much everything that we would look for. The only problem is this is not the time of day that I would want to be trading. Spreads are a little bit bigger, volatility there, but it doesn't mean that there wasn't potentially opportunity, or that if this had happened at like 10:30 a.m., that it wouldn't have been at that time something we would be all over. So, that can be kind of on a tangent here, but that can be a challenge with trading, is inconsistent reinforcement from the market. The same pattern at a different time of day will resolve differently. More traders are active in the morning, more interest in the market, better resolution. So that's our 5-minute chart. Our 1 minute, what does it show? A doji at the top. Looks like we had a halt going up here, resumption, pulled back, the high. So what are we gonna do at 10? Resistance at 10? It's a double top right now. See how it's got that double top? So it's got to break through that $10 level. It's pulling back again, but sometimes these pull back a couple times before they break that level. A 10-second chart can sometimes help you visualize the pullbacks, right? If you have it available. So the low here, hard stop would be 920, I would say, down in the low of this candle. Not liking the look of it. Uh-oh. So that doesn't look good to me. Now, the only problem is that you might have support at $9. Whole dollar, psychological support. So some people would say, well, I don't want to stop out at 920. I'll just hold till 9, psychological support. Which, I can understand that, but if it does then break 9, it could flush down to 880 and drop hard. All right, so there's a former runner. Good, nice example in real time. Another former runner here, big day, a period of pulling back after a big day, not uncommon at all. And then it pops up here up to whatever that is. So this is a day where it comes out with news. It's not perfect, being slightly below some of those moving averages, but it's not terrible. Again, this one popped up, bounced off the VWAP or off the 200, then ripped higher, strong drop, back down to the 200, bounce off that level. Volume coming in, high relative volume. So the days this would be worth trading, certainly here. I don't know about here, maybe, sort of. Probably on this day here, that green candle, and kind of all through here. Each of these days were probably valid for trading. The only thing I'll say is that sometimes when you have a stock that's on a multi-day kind of period of momentum, sometimes they are not as, sometimes they start to get a little played out, they get a little worn out, they stop breaking out as easily. I think it's as people start to get more familiar with their price action, they start to trade them a little more actively, shorting pops, buying dips, and it kind of can sometimes regulate the price action a little bit and make it a little more congested, but sometimes they do continue higher and can give some good opportunities. So like on this stock, I traded it on this day, but I didn't trade it on this day. On this day, I was like, oh, it's breaking, but I don't know. It was kind of grinding. It was sort of choppy. And then this is the day where it really went crazy. And the volume was so much higher on that day. So you don't have to trade those on every single day. Again, former runner, nice moves. First kind of nice pop here, a little bit there, a nice one back here, almost coming back up to the highs. Now remember, when you have a stock that had a big move and is sold off, you have some people in this area who are, what are they? I'll give you a hint. Here's the fellow, here's his head, there's his arm, and what is he holding? He's holding a bag. He's a bag holder, all right? So he's holding stock from up here. And he's thinking, or she's thinking, oh, I don't want to sell it. I'm sad, I'm frustrated, I should have sold sooner, but now I'm holding it forever. I'd rather hold it forever than sell it. Well, on a day like this where it comes up, if he or she hasn't already averaged down, they might have an order just to get out break even at 14. So as it comes back up to 14, you might see sell orders starting to go through as some of these bag holders are just like, oh, thank God, I'm out of it break even. Right? And, it won't be until it actually breaks over the high here that I think you really start to see some like fresh action. Not to say that this from 8 up to 16 wasn't a 100% move. That's a great move, but just to be mindful of the possibility of some people that are under the water as bag holders. So saw that a little bit on this stock, pops up and sells off, pops up and sells off. So this, I would kind of say, is the opposite of a former runner. It's a former failure. It's a former, dropper. It's a former stock that every time it pops up, it fades. And it's so predictable at this point that I don't want to trade it. I would really have no interest in it because every time it pops up, it fades. Now, what are short sellers going to start to do? They're going to start to get really aggressive because they're going to think every time it's just a win to the short side. The one time that it, for whatever reason, rips up and starts to do the opposite of what you expect, well, that would be the time that I might consider, okay, going long. Because now it's actually, it's doing something unexpected. But otherwise, I'm not interested. Daily windows, we've talked about in the starter class as being areas of no resistance. So those are those pockets of opportunity on the daily chart formed by large windows, large candles, or large gaps. But sometimes a window that you have will be crossed by something like a moving average. So as the stock is coming up, even though there's a window, it's got the 200 blocking the way. So the best setups usually have multiple windows. And you can see this is a stock that has a lot of windows from here to here to here. And then there's kind of nothing in this area here, but then there's another one kind of right in here with that green box. And then a little bit of one up to the red line, and then nothing kind of in here that's really big, and then a big one starting at the green line to the next green line to the next green line, and then to the red line where it kind of stops again. And then another trigger at the green line, and then up to the red line where it stops. So this is a stock that when you have lots of gaps and windows, they can help us predict possible areas of support and resistance. I mean, especially when it has some serious momentum. Now, the average true range is something that is a technical indicator that some traders will talk about. I actually, I don't really use the ATR. It's a technical indicator. And what it does is it tells you the average range of a stock. So if I add the study here, average true range right here, this tells you on average how much the stock moves each day from top to bottom. So this says it's $1.30 right now, GNUS. Previously it was way down here. But I mean, although this is giving you a numerical understanding of how much it can move up or down in one day, it's also kind of obvious just based on looking at the chart. Something like LEDS, 38 cents right now. Something like Sirius Satellite Radio, ATR is 24 cents. Ford, ATR is 37 cents. Tesla, ATR is going to be huge. $41. It's insane. It's a huge ATR. So sometimes, I mean, there might be some traders that use ATR to help them look for swing trades, because you might think, oh, well, a stock that has a high ATR that moves a lot could be good for swing trades because within a period of a few days, it could potentially move up or down $40 a share. But for day trades, I don't use it as an indicator. There was a period where I would tell people that, you know, you want to look at something that has higher ATR just so it helps you avoid stocks like Sirius Satellite Radio. But something like JFIN today, which has been super weak here on this sell-off, this is actually going to be not a former runner, but a former failure, just because of how much it's dropped. It's now red on the day. It's really terrible. But the ATR was 19 cents. So this morning, would you have said, oh, it's got 19 cent ATR, I shouldn't trade it? No, I wouldn't have done that. And now the ATR is going to go up after today because it lags behind. So we obviously look for stocks with higher average true ranges because those are going to be more volatile. But I think looking for the ATR as part of a scanning strategy is actually not going to be beneficial. So I'm actually going to go ahead and remove this sentence here. Yes, we look for higher ATRs, but it's not an indicator that I'm using at this point, and I don't think you need to use it. So I'm just going to update that. That's slide 208. 208, remove ATR. It's not a bad idea to know what ATRs are, but again, in terms of it, this would be more of creating daily watch lists of potentially strong stocks, and I think that's more of a swing trading strategy than a day trading strategy. So we talked in the starter class about those daily resistance levels. I talked about looking left and up, looking for the most recent level of resistance. Now, this is where ATRs could come in, but I do think that this is overcomplicating it a little bit because essentially what you're looking for is, and let's pull up GNUS again here. So GNUS, the ATR right now is $1.30. All right, so if I look to the left and up, how spaced out are these? So this one from 735 certainly has a full ATR in it. That's a huge, huge window. This one from 580 to 635, not so much. So, I would say break a 580, the next level is 635, but it's not as significant when the window is smaller. So we like to see bigger windows. One way to measure that is just to eyeball it, which is what I do. So I just look at it and I can visually see that's smaller relative to these ones, which are bigger. The bigger ones are going to be more valid. ATR could be something you use to help measure that, but I really don't think that you need to do that. I think that I just don't think you need to do it that way. So just don't overcomplicate it. That's the important thing. If a window looks big, then it's worth watching. And the price is to the penny. 580, 635, 735, those are prices to the penny that are worth watching. So when is a line on the chart, like I just showed you, resistance, and when is it a trigger? Well, the truth is, any trigger can be a form of resistance as well. This has a lot of room above 735, but it could also be resistance. It could form resistance there. I would typically say resistance will be if we don't really have anything obvious above it. This looks like a trigger because above that level we've got room, but sometimes triggers do serve as resistance because it's so significant, it's so obvious, traders are watching it, and it cannot break through that level. So a trigger can be a resistance point. The top or bottom of a window can be both resistance or a trigger for the next move higher. I would generally say that if the resistance level, if the next level is very close, then it is just probably going to be resistance and not really considered a big trigger. So in the case of a different stock like ABIO, this 45 is definitely not, I would say this 43 spot, the high of this, is really not a trigger because the next resistance is at 46. It's so close. But over 45, 46 here, that is more of a trigger because then that gives you room up to this level. So although you could mark that out as being the high, I would say that that's maybe a small little resistance spot, and it's really over this next level that it's more interesting. So breaking down the daily chart, again, the green lines here are where I would say it's a trigger. So from the green line, it has room up, but at the red line, that's the top of the window. So that's kind of where it's hitting resistance. In this case, it's gap fill. And I'll make this a little bit bigger for you guys because I know it's probably a little hard to see. So hang on. All right, so what we're looking at here is from 1366 to 1583. 1366 is the high of this red candle, and then 1583 is the resistance of gap fill. Above 1583, there wasn't really any significant levels until this green little trigger at 20 that then has a nice window up to 21. But then above 21, there's not really anything super obvious until 27. And then that has a nice window here formed by this red candle up to 30. And if it breaks 30, it has actual gap fill up to 34. And if it breaks 34, it's got room up to 36. But then above 36 is kind of resistance again. So you don't have to break down the chart with all those colors. I only did this for the sake of hopefully helping you guys better, better visualize whether or not you should look at something as being a trigger or a resistance level. So why was 20 a trigger? 20 was a trigger because I thought the room up to 21 was large enough. It's a little bit hard even for me to see, but this is a candle with a high of 21. So it's got $1.50 just about in no resistance. So again, you could probably say like maybe down the line right there could have been another one also. But so let's look at this. So From 1556, that's a trigger that gives you room up to 1821. No question about it. That's gap fill. Now, what is 1821? Is that resistance? Well, gap fill certainly would be the target, and that probably would be resistance. But if it broke 1821, it does have room here up to 19. So it could also be a little bit of a trigger for the next leg up. Here's another one. All right, so definitely 381 is a very clear line, and so is 655. That's gap fill. And this filled the gap almost perfectly to the penny. So this was resistance. Now, if it had broken that level, it did have room up to here, but often we find that gap fill is a pretty well-respected level of resistance. Here's another one. All right, so the gap fill was from this line here up to here. So a nice big window that it started to get into, but it did have some moving average resistance, and it was only able to get up towards about 8. If it had broken 17, it had room up to the high of actually this candle right here, which, you know, a small little spot, but it probably, if it had actually gotten all the way to 17, would have slowed down at that point. Here's a daily chart with a big gap from 323 all the way up to 858. But the 200 moving average does cross, and so does the 50, and probably the 100 is in the middle. If it breaks 858, I mean, that's gap fill, so again, that would be the target, but it does have a little line here and a little one up here. Here's another one, gap fill. The gap down, then the gap up, or then the window up to the low. So that's from 329 up to 850. 200 moving average, though, is in the way. So this one has no resistance from this spot right here of 77.98, just under the whole dollar, up to 82.66. And in this case, it actually broke through the gap fill and hit basically the top right here of this candle. So this actually broke through and came up to the next resistance spot. It then pulled back under that level for 2 days before breaking through that. And then once it broke through that, it had room up to the high of this candle right about here, which it almost tapped to the penny. TripAdvisors. Here's another one. This is a window. So not a huge window. It's only about 24 cents. But once it breaks over 372, since it's above its moving averages, it really doesn't have any resistance until 396. You could say maybe there's ascending resistance if you drew this, but this is a little more obscure. I'm not sure a lot of people are going to be drawing that type of trend line. So I think the obvious ones that are horizontal are going to be better respected. GLBS above 877 has a window to 1950, but it is formed by a red candle, which is a little weak. And so in this case, we may see that 877 is going to be a little bit of resistance because it's coming up to that level. It's already up quite a bit by the time it gets there. So here's another one. Let's see, what do we have going on here? So on this one, just pull up this chart. I saw you mentioned DGLY, so let me just look at DGLY. DGLY popping up a little bit. Yep, I see that. Intraday, I see an intraday kind of resistance at the top, whole dollar. It's a little bit of a different setup. So this is an example of a kind of bad daily chart. It's got the moving averages above it. Obviously, the 100 is in there too, somewhere, the 50, the 20, the 9. You know, if it got above this level, maybe it starts to look good up here, but it's a ways from that happening. Here's another one that doesn't look that great. It's below the 200. It's pretty close to the 200. If it can break over 350, if it can break over 350 right here, then it has room up to the high of this candle, 433. Then it's got gap fill up to this candle here, 531. But first it has to break through the 200. So the moving averages and the windows, all of this sort of comes together. You know, you have multiple layers of analyzing the daily charts. This is a weak daily chart. It's just been selling off. It's below its moving averages. Sometimes when something has been selling off for a really long time, I'll be interested, but because it's been low for a long time, the moving averages usually have gotten underneath it and are flat. And then we look as it starts to curl back up. Let's see. So this one, nice daily, but moving average resistance, which can be a problem. So this has room from 497 up to 867 on gap fill. but it does have moving averages in the way. Now, because the gap fill is pretty well noticed, I think people would probably still take a trade on it if the news catalyst was strong, and it does have a recent reverse split. It is a former runner, so it probably would still be worth trading, but a little cautiously to see whether or not it opens up. Bad daily chart, no windows, moving average resistance. This one just has nothing good about it. So sometimes when I was getting started, I would look at a chart like this and I'd be frustrated. I'd be like, I don't see anything. I don't see any setups. Nothing looks clean on this chart. Some charts are like that. And that's good that you recognize that there is nothing clean on that chart, because there really isn't. So this is, at this point right here, a very weak daily chart. It's just selling off. Back when it was in this area, it was had been weak for so long that it was getting above the moving averages and starting to actually curl up. Now, we talked about support and resistance trend lines, that they can be horizontal, or that they can be both horizontal and ascending or descending like that, and they can also be in wedges as well. So that sometimes they're a wedge like this, or sometimes they're condensing like this to an apex point. So this is a stock that was trading in a channel right here, as you can see. So a nice channel. This is the same one that we showed in the starter class, trading in this channel down here as it was selling off. This is the same one that I showed you as well, holding support right here. But these are trend lines that are not as obvious, and so traders may not draw. Oh, sorry. So traders may not draw them as much as they would draw something like a basic horizontal line. Thanks, I forgot to fix that. It's kind of not a picture perfect way of doing this, but that's okay. Just lining that back up. Okay. Hopefully you didn't miss too much there. I think most of those were kind of zoomed in a similar way. So anyways, so yeah, again, I'm not a huge fan of ascending and descending lines. I don't draw them as often, but every now and then I will. And as we talked about in the starter, the more times a line has been tested, or the more obvious the place is, the better it will be respected. So especially with ascending and descending levels. So, just something that you should be mindful of there. And I won't go through how to draw a trend line again, because we did cover that more in this last round of the starter class than we had in the previous classes. All right, so next we have number 7, which are daily chart patterns. Okay, so we've got the daily flag patterns, and they offer, without a doubt, some of the best opportunities when they coincide with a technical breakout. One of the problems with trying to trade bull flags or flat top breakouts on the daily chart is that although you have a pattern that's forming, what creates resolution is volume. And without breaking news of some type, a purely technical breakout, which would be the resolution of the flag pattern, usually won't be as well noticed. The relative volume will often be lower, and we don't always see really good trades come from that, which is disappointing. So this right here is technically the first daily candle to make a new high, which is kind of like a really short flag. This would have been okay to trade because it was only one day after the big move. So people would have still been watching it, same as people have been watching GNUS. So like GNUS had a little bit of a flag pattern, but then kept coming out with new headlines. So it resolved out of this pattern fairly well, broke, pulled back, came back up, broke through the high, and then people were watching it day after day. So in this context, it's okay on a small cap stock. In the context here, the first daily candle to make a new high is a valid setup, and that did give us a move from 840 up to 1190 because it was on a former runner. Even just the first candle to make a new high gave like a 25% pop. I mean, that was nice. So we will see them sometimes work a little bit better on small caps. On larger cap stocks, not as well. So again, here, former runner, a pullback day, then the first day that pops up, it gets follow through. So traders were still watching it. This is one that was a little bit slower. It pulled back, moved up, not all the way back to the highs, pulled back, moved up. The day it broke out right here, kind of a lackluster breakout. It kind of just, it almost double topped. Then it pulls back. A second day of not really working, and then it works. So it's kind of hard to predict which day it's going to open up. This one, this was the day that it broke right here, and it was red. So it broke and pulled back, and then, I don't know, maybe it was on this day that it had news, but it's not uncommon to see those false starts, which can be a little bit disappointing when that happens. This began with a reverse split that popped up, sold off, came back up, sold off in this kind of wedge pattern right here, broke out, resistance at the high, finally broke that level and then gave a nice move, but it took a few tries. So not really instant gratification. Long consolidation through here, finally broke this level here, but I don't think this was purely technical. I think most likely this had news on this day. Now, is it possible that the news was timed with the chart pattern? I don't know. I mean, it's possible that some companies would do that, but I'm not really sure. Again, first candle to make a new high, but that was formed by a gap. Again, formed by a gap, and then here, consolidation and a breakout. But these are they're not perfect, but they are sort of the first daily candle to make a new high. This was a recent IPO breakout. Squeezed from $20 to $140, pulled back, consolidation, little pullback right there, and it opened up. But the thing is, the daily flag patterns, sometimes they can add some momentum to an intraday setup, but you need the intraday setup. If you don't have a daily setup, if it's okay, but if you have a daily setup with no intraday setup, that's not something I would trade. I need the intraday setup. So I might say, okay, this is interesting, but it could be really choppy. It could just be kind of grinding higher, but not really easy for day trading. Here's one where, first candle made a new high, popped up by a couple pennies, then dropped, popped up here again, dropped hard, ripped back up right here. Probably there was news out. I don't think it had this much volume without news. This is a former runner type of setup. And it's an okay breakout above the high of this red candle. Next resistance spot would have been here, the high of that red candle, then room up to 7. Resistance was at the whole dollar. Resistance here was also around $5.50, around the half dollar. Resistance here was at 4, around the whole dollar. So some predictable price action there. But, again, as I'm pulling up my charts pre-market, I look at the daily chart, but I don't usually expect to see like a daily bull flag or something like that. The daily bull flags, usually I'm trading a stock that has breaking news today, and the daily chart may have been just, nothing up until the day it had news. IMRN yesterday, this wasn't like a daily setup at all. From a flag pattern perspective, it had news, gapped up, and ripped. That was all intraday action. JFIN today, which has now come lower, the high was right around $30. But that wasn't really an intraday setup. It had a couple resistance levels that we were aware of up around these highs, but it wasn't an intraday setup. It wasn't a daily setup. The intraday strength was so strong, and now, so weak, just kind of crazy. But in any case, it didn't really matter what the daily setup was. So, if a stock comes out with amazing news, just think a stock comes out with the cure of some terrible illness, that's going to override any daily chart. Now, when you have a stock that does have a nice daily chart, that'll give maybe people some more confidence. Maybe you'll see better follow through, but not always. It's still good to know what a good daily chart looks like. So chart patterns that we'll review tomorrow on an intraday basis will be bull flags, bear flags, flat top breakouts, flat bottom breakdowns, moving average pullbacks and pops, and then the ABCD pattern. We're going to talk about a number of different chart patterns when we really get into the strategy sessions, but in terms of intraday patterns and a few of my favorite charts, we will break those down in Chapter 5 tomorrow. And you can sort of reverse apply those to daily charts if you want. When we break down the intraday ABCD pattern, you could certainly draw that pattern on a daily chart if you see it, right? But it's not, without the catalyst, it's just not really worth it. So it's kind of an interesting thing. I'm not trying to say that daily chart patterns aren't important, but it just happens that the only times they're really relevant is usually when the stock is in former runner status, because it just made a big move a couple days or a couple weeks ago and is currently pulling back off that breakout. Because then we sort of look at it as a daily flag. Otherwise, it's just, do we have moving average resistance, and where are our horizontal triggers based on recent highs and lows? So in terms of setting up your charts, we're setting up our charts to give us a better understanding and context for the current price action, because ultimately the chart it's a historical look back. So as we look back at JFIN, we would say, wow, this was a really incredible stock, but at the same time, this is kind of really disappointing that it dropped as hard as it did here and is actually closing almost, right on the day. Like, it really didn't hold up very well at all. That's kind of a shame. We've had other stocks like GNUS that certainly held up better over a period of several days. So, the daily chart gives us that historical price action. We can say that this is a stock that was a former runner, a multi-day period, and was incredibly strong. JFIN, we would say, yeah, that was a stock that was really strong intraday for like half the day, and then like rolled over and was terrible. So in the future, we would probably be pretty hesitant to trade this stock, to be honest, until it breaks over this level and proves it's strong enough to reclaim this kind of ugly red day on the chart. So steps that you guys can take today, you can certainly, I do encourage you to keep your charts simple. Keep it simple. It's very important. What moving averages you use ultimately is your decision. You can use what I use. You can add a few more if you'd like. But I would encourage you to keep it simple. Each day when you're looking at your gap scanner, you can start looking at the daily chart of these stocks. It is usually one of the first things I look at. The first thing I look at is the intraday chart. So DPW, first thing I check is intraday chart. And if that's strong, that's the first thing I need to know. Because if the intraday chart is really weak, and I can't think of a gapper today that had a bad intraday or a bad pre-market chart, but I don't know. What did we have? We had one yesterday. Let's see. DGLY. Yeah. So, that's nothing special. This, I'd say, was a bad pre-market chart yesterday on DGLY. It was already selling off. So as soon as I look at that chart, I'm like, yeah, the high was way up here. It's already showing weakness. It doesn't look that great. Obviously, we'll talk about that more in Chapter 5. But the first thing I look at is intraday. And if the intraday pre-market is weak, then I sometimes won't even bother looking at the daily chart. There's no point. But if I look at the daily chart of a stock like DPW and I see that the pre-market is strong, then I'm going to say, all right, we've got a good pre-market. We've got a pre-market high of around 5. Let's go pop this over to the daily and see where our resistance levels are. So then I look again left and up to see where's the next resistance point. So in this case, we had room from about 420 up to 484. We did have a little line here, which I should have drawn. So a little resistance, 438, then to 484, then room back up to 1068. Now, if it breaks that level, we've got room higher, but I don't need to probably draw out all of those right now. So now I switch back to the 5-minute chart. So now I've got my daily levels drawn, and pre-market, I would be thinking, okay, well, it's above 484. So we don't have any resistance on the daily until 1068. Just go back and double check. Did we have any 200 moving averages in the way? Back this up a little bit. Oops, sorry. Let me grab my charts. So I don't see the 200 even on the chart. Oh, well, that's because I switched to the 5-minute. So let's go over here. So the 200's at 15. So we've got lots of room to the 200. And actually, this is one of those things that I mentioned before that's annoying about eSignal. Where'd my 200 go? I want the 200 on the 5-minute chart. And sometimes I don't know, it disappears. Well, looks like I just clicked something there. So let me close this. I'm going to press undo. Switch to 5-minute. All right, so I'm going to go back in here and add the moving average. Because, sometimes when I'm trading, and then I realize later that the whole day I've been trading without my 200. It's like, well, gosh, I didn't see this potential bounce spot that I would have seen if the indicator was turned on. I didn't realize it had turned itself off, or it had somehow disappeared. So we're going to delete this, delete, and we'll delete that. So the 9, the 20, and the 200, that's what I wanted. So look, there's a bounce off the 200 there. I wouldn't have taken that. But still, if you didn't have that moving average, you wouldn't have seen that. JFIN, did this bounce off the 200? Not really. It didn't really bounce too much off the 200, so didn't miss too much. And TO, by the way, refers to today's open price. So that's the open price, which can sometimes be a bounce spot or a breakout spot on a red to green move. All right, so again, keep it simple. Look at those daily charts when you're looking at the pre-market watch list of the gappers. And tomorrow, when we come back to Chapter 5, we will fill in more of the detail of chart analysis by breaking down some of the intraday chart patterns that we rely on heavily. And if you want to apply those patterns that you learn really in that context back when you see them on the daily chart, that's fine. But I just wouldn't expect the daily chart to resolve, because the reason 5-minute intraday patterns resolve so well is because on this day, right now, traders are watching this stock. They're watching it because it has above average volume. It's already shown a tendency of making big moves. So this is actually an A, B, C, D setup, with the entry being a break of 1478. It's a pattern we'll talk about tomorrow. This same pattern on a daily chart, so each one of these candles, pretend it's one day. Well, what creates this big resolution here? You're not really going to have big multi-day follow-through short of a stock having fresh catalysts that are really, really strong, unfortunately. So this pattern on a daily chart, might give a quick little resolution, but without fresh news, it's very unlikely that you would see really big resolution like this. So we're going to really apply most of our technical analysis from candlestick patterns to the intraday charts. But again, I can't go into intraday charts without you at least knowing the basics of dailies. So, I think hopefully we've done a good job here. And as we look through more and more charts and more live trading examples, it will only become more clear. So stick with it, and I will see you guys back here tomorrow for Chapter 5.